Warren Buffett took $100 and turned it into billions from his investments. And do you want to know the secrets that he applied to make that a reality? You're going to find out in today's video, and you're going to want to stick around for lesson number 3 because it's something that you wouldn't even suspect. All that and more in today's video. What's going on, everyone? Jeremy Ritz here. Courage pays better than fear, and it is no secret that Warren Buffett is the OG, the man, the godfather of investing, and we can all learn something from him that we can apply to our own finances when it comes to investing in markets. Now, investing is very different from trading. It's when we're buying a company and holding it long term and letting it appreciate in value over time. And there are specific principles that Warren Buffett follows that we're going to talk about today so that you can get a little bit of that Buffett magic in your portfolio. Lesson number 1 from the OG himself: time in the markets is better than timing the markets. Buffett has said, quote, "The stock market is a device from transferring money from the impatient to the patient." There is volatility in the markets. There are wild swings up and down, and day traders take advantage of those swings. But in investing, you are committed to a company long term. You ride through the highs and the lows. And again, if we just look at an SPX chart from its inception till today, you could see that it has one direction, and that's straight up. And Buffett knows that and understands that, and that is part of his investing principles, is to be patient, something that a lot of people are not. And when you look at the charts and you see these short-term dips that we have, corrections, even bear markets, those long-term investors who just held through that and were day trading in and out, oftentimes they're going to have greater returns than those traders. And take, for instance, Buffett's position in Coca-Cola. He bought that in 1988 and he still holds it today, and it's returned 18 times his investment. How crazy is that? Long-term discipline crushes short-term greed, but it's not just all about patience. It's about picking the best companies where to park your money. So let's take a look at lesson number 2. Lesson 2 from good old Buffs: buy great businesses at fair prices, not cheap businesses at bargain prices. And Buffett has a quote that says, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." And so we want to identify those companies that have great fundamentals, cash flow positive, very little debt. They have a proven track record, great leadership. People use their products. They have a significant following, a customer base. They have a moat. They're protected. Those are the companies that Buffett suggests that we look at for our long-term investments. You look at companies like Apple, Microsoft, and yes, Coca-Cola, as we mentioned earlier. These are solid businesses that have been around for quite some time and have proven time and time again and have a track record of success. That's where you want to put your money. Not with a company that just has speculation or a promise of doing something in the future, but someone that has proven results. Take Apple, for instance, one of Buffett's greatest investments. He invested in 2016, and look at the Apple stock today. It's almost at new all-time highs, almost up near $260, and what a return. But Apple's a great company. Think about it. How many people that you know have an iPhone? And it's quite a lot. It's a great company, great products. It has a loyal following, and Buffett identified that and invested, and he made a killing in terms of his profits. The takeaway here for lesson number 2: don't buy penny stocks. Don't chase speculative garbage. Invest in companies that have solid reputations, that have strong financials, and that's going to provide you with the greatest return on your money. Then lesson number 3, and you've heard me say this a million times on the channel, though Buffett came before me, and he is much better looking, much smarter, and much wealthier than I am. But here's the lesson: control your emotions. The market is a voting machine in the short term and a weighing machine in the long run. And Buffett has this quote. This is one of my favorite quotes of all time. Be fearful when others are greedy, and greedy when others are fearful. And if you think about this, when there's market weakness, when you see big drops in the stock market, people are afraid. They dump their positions. They're unwilling to hold through that volatility. But Buffett sees those big dips as opportunities to snatch up high quality companies and to hold for the long term. And you and I know fear and FOMO destroy portfolios more than anything else out there in the investing and trading world. For instance, in 2008, when everybody was piling out of Goldman Sachs, Buffett invested. He paid $5 billion in cash for his investment and cashed out many billions beyond that. And it's just an example that when there's blood in the streets, when the market is dropping, buying, not being fearful, knowing that's an opportunity, it will pay off in the long run. So the takeaway for lesson number 3, the best investors aren't the smartest, aren't the brightest, they're the calmest. They have discipline and they're in control of their emotions. So those are Buffett's top 3 lessons to follow as an investor. Patience, buying great businesses, and controlling your emotions. Which one do you struggle with the most? Drop that down in the comments below, and while you're at it, smash that subscribe button, and I'll see you back here for the next video.